the hidden cost of big tax refunds. Why a larger check might be a financial mistake. Recent data from the IRS indicates a growing trend in American tax filings. The average tax refund for 2026 is projected to be $3,623 as of mid-March, marking a 10.8% increase from the same period in 2025. While a larger windfall often feels like a victory, financial experts warn that this "bigger is better" mentality is actually a symptom of long-term financial mismanagement. The illusion of found money. The primary issue lies in how taxpayers perceive these payments. Because tax withholdings are automatically deducted from monthly paychecks, many people view their annual refund as a bonus or found money. In reality, a tax refund is simply the repayment of your own money that was withheld in excess of what you actually owed. Large tax refunds are not a good thing because it means you gave the government an interest-free loan for 12 months. Explains Brennan Kohler, founder of Atlas CPA Index. By overwithholding, taxpayers are essentially providing the U.S. Treasury with an interest-free loan. In the case of the 2026 average, taxpayers effectively surrendered roughly $300 every month that could have been utilized for their own financial goals. The psychological trap of the bonus mentality. Beyond the lost opportunity cost, there is a significant behavioral risk. Financial planners note that people tend to treat large, lump sum refunds differently than regular salary. Stable income. Monthly wages are typically used for predictable expenses like rent, groceries, and bills. Windfall income. Large refunds are often treated as extra, leading individuals to spend them more frivolously on non-essential items rather than using them to build wealth. This psychological shift means that instead of the money building an emergency fund or an investment portfolio, it is often depleted quickly on consumer goods. How to reclaim your income. The W-4 strategy, the goal of efficient financial planning, is not to receive a massive check once a year, but to maximize your monthly cash flow. To stop giving the government an interest-free loan, experts recommend adjusting your withholdings so that your total tax bill at the end of the year is as close to zero as possible. Steps to optimize your withholding. Use the IRS Tax Withholding Estimator. This tool helps you calculate exactly how much should be taken from your paycheck to meet your obligations without overpaying. Update Form W-4. Once you have your estimate, submit a new Form W-4 to your employer to adjust your payroll deductions. Monitor life changes. Tax situations are not static. You should reevaluate your withholding whenever major life events occur, such as starting a new job, having a child, getting married, or divorced. Significant changes in investment income. Why this matters. By shifting from a refund mindset to a cash flow mindset, you move control of your money from the government back to yourself. Instead of waiting until March to access your funds, you can use that extra $300 each month to contribute to high-yield savings accounts, retirement funds, or debt reduction, allowing your money to work for you all year long. Conclusion: a large tax refund is not a sign of financial success, but rather a sign that you have mismanaged your monthly cash flow. By adjusting your W-4, you can keep more of your earnings throughout the year and put them to work immediately.